Welcome to the webinar today. My name is Alexandra Alvarado, and I'm the Director of Marketing and Education here at the American Apartment Owners Association. So glad that you could join us. If you were on our previous webinar, I definitely talked this one up, so I hope that some of you came through from that. We have been anxiously waiting to talk about the One Big Beautiful Bill Act, which has a ton of new stuff in it and a lot that will affect rental property owners. And so we're definitely going to dive into that. So stay tuned. Just a quick few things before we start. We are recording this whole thing and we'll send you the recording and the slides tomorrow, as well as our speaker's contact information, who, by the way, I can give a brief intro to. Richard Gann. Rick has actually spoken for our group many times. He might be a familiar face for you all. He has been a member actually of the state bar since 1997. While finishing law school, he and his friend started 1031 Capital Solutions and now have been working together for over 20 years, really helping landlords and real estate investors to essentially work their 1031 exchanges into DSTs. And he is really, I think, an educator primarily, as we've seen. He's great at really showing us in really easy to understand terms what's going on in not just the 1031 world, but also here in what's happening in the tax world as well. And so we are going to start in just a moment. If you're coming in still, if you want to put in the chat at the bottom where you're coming in from, we'd love to know what part of the country. We have people from all over. I'm here in Los Angeles, so if you want to put that in the chat, you certainly can. Now, you'll notice next to the chat, hi, Cheryl from Cruz, California. Nice to see you. Lynn, Harrisburg, Pennsylvania, Florida, wow. Seattle. Lots of different places here, Houston, Texas. So if you could, whenever you have questions, because I know you're going to have plenty of questions, there is a Q&A box. It's not the same as the chat, okay? It's in a separate little box. You can see it if you scroll, I think at the top or bottom of your screen, you can put in any questions you have there. So we'll prioritize those and hopefully get to as many as we can at the end. And if we can't get to your question, which is very possible, we will make sure we have someone respond to you offline. So it's definitely worth putting in the question there. So with that said, I'm going to hand it off to our speaker today, Rick. Thank you, Rick, for coming back to talk to our group about this really timely topic, I have to say.
Thank you, Alexandra. I appreciate you and AAOA having me on again. And I really appreciate the opportunity to address folks who provide rental housing across the country. Sounds like we have a diverse geographic group today. And so thank you all. I hope you're all having a good day wherever you are. We know you probably have at least 100 more exciting things to do than attend a tax update webinar. So I appreciate every minute of your time. Again, my name is Rick Gann, and I'm a managing partner with 1031 Capital Solutions. And my goal for today's webinar is to convey what I think are the most relevant aspects for rental property owners of the major budget bill that became law on July 4th. Now, before we go any further, I am required to tell you that this presentation is not a solicitation. Real estate and real estate securities may not be suitable for all investors. The risks of investing in real estate programs are no less than the risks of direct real estate ownership. Investing in securitized real estate programs typically involves higher fees than traditional investing. Investing in qualified opportunity zones involves development risk and requires extended periods of illiquidity. Investing in mineral rights and drilling programs is highly sensitive to energy prices. And although the name of our company is 1031 Capital Solutions, we cannot give tax or legal advice. A little bit about us. The 4 branch offices in our network are in San Diego, where my partner Jason McMurtry is, in Sacramento, where Jamie Furlong heads up the NorCal team under the Legacy Investments and Real Estate banner. And in Colorado, where Holly Stewart heads the team at Summit View Advisors. And in Seattle, where I spend most of the year, and currently, in addition, we have folks working remotely in Portland, Los Angeles, and Denver. In a nutshell, we are a financial services firm that exists for the purpose of helping individual property owners retire from being landlords. And on that note, in May of 2020, we published a book on this very topic, which is available in both print and electronic formats on Amazon. However, if you go onto our homepage, you can easily find a link where you can order a free hard copy. And I believe as part of your registration today, you're going to have an opportunity to get the book sent to you. So please don't pay for the book. We will send it directly to your door. And as Alexandra mentioned, we do intend to provide some time for Q&A. But if we don't adequately address a subject or answer a question, please know that you are welcome to schedule a call quite easily by visiting our website. Now, before I get into reviewing the key elements of the One Big Beautiful Bill, let me start by saying how crazy it is to me that we even have to have a webinar like this in the first place. Not only are taxes a political football in this country, but in nowhere else on the planet are citizens subjected to so many overlapping layers of taxes. And perhaps the most egregious of these is the capital gains tax. At their core, capital gains taxes punish individuals for success, for risk-taking, and for long-term wealth creation. And unlike ordinary income, capital gains often reflect inflationary growth rather than real economic gain. Taxing these gains imposes a penalty on savers and investors who are trying to build security for themselves and their families. Moreover, capital gains taxes represent a form of double taxation, as many assets subject to capital gains taxes, such as shares of stock, were already taxed. And finally, as many of you are aware, the prospect of paying capital gains taxes also distorts behavior, causing many people to delay or even avoid selling appreciated assets, especially rental properties. And so at 1031 Capital Solutions, we really pride ourselves in guiding clients every day through the minefield of tax-efficient investing and helping people achieve, frankly, a more equitable tax burden for themselves and their heirs. And I encourage everyone on this webinar not to merely accept unfair taxes as a fact of life. Start by voting with your pen, and then vote with your wallet, and then when necessary, vote with your feet, which is why I now live in a state that does not impose an income tax. And if you feel like you can't make a difference, just remember my grandfather, Paul Gann, who at the age of 67, despite never having graduated from high school, successfully enacted the most famous ballot initiative in the history of the United States, known as Proposition 13. So with that, I will get off my soapbox and let's talk about the One Big Beautiful Bill. And the first topic impacted by the One Big Beautiful Bill is the Qualified Opportunity Zone Fund. A Qualified Opportunity Zone Fund is a limited partnership, LLC, or REIT that invests in properties located in Qualified Opportunity Zones, or QOZs. And per the Invest in Opportunities Act of 2017, a QOZ is a neighborhood designated by the government to offer certain federal tax incentives for development or revitalization. And under the original law, there are 8,700 QOZs in the United States. In other words, zones, 8,700 zones that qualify for special tax treatment. To designate these specific zones, government officials applied QOZ criteria in 2018 to census data from 2010, when many census tracts had not yet bounced back from the Great Recession. It is likely that many of these zones would have exceeded the maximum income thresholds if the boundary drawers had been required to use 2018 data. And as a result, many QOZ projects likely would be built regardless of the zone boundaries, on the basis that economic and demographic conditions, already supported the demand for the proposed apartment building or hotel or storage facility or whatever was being constructed. Nevertheless, the idea behind QOZs and QOZ funds was to provide a meaningful tax incentive for developers to invest capital in these specific neighborhoods around the country. And specifically, QOZ funds offer three different tax benefits to investors. First, you can defer capital gains taxes on any asset you sold by reinvesting your gains into one or more QOZ funds. So the first is deferring capital gains tax on some previous asset that you sold. Secondly, there's an opportunity to reduce those deferred taxes based on the timing of your investment. And then third, if you hold your QOZ fund investment long enough, you can avoid any further capital gains taxation resulting in the future appreciation, ideally, of whatever QOZ fund you invested in. Well, under the previous version of the QOZ law, the tax deferral extended only to the spring of 2027, and the window for a partial reduction of the deferred taxes has already expired. So as we, initially in 2017, we saw a lot of activity and a lot of excitement in and around the QOZ funds. As we've gotten closer and closer to 2027, then the tax deferral and tax reduction benefits really started to peel away. And so, there was a call for renewal of these benefits to Congress. And thankfully, the new law makes the Opportunity Zone program permanent. Qualifying census tracts will be established for the new program starting July 1st, 2026, and then will be reestablished every 10 years thereafter. And investments under the new program could be made starting January 1st, 2027. So we're going to see a little bit of a gap in 2026 as far as being able to benefit from investing in a QOZ fund. But once all the new zones are in place and the new rules take effect, I suspect there will be a renewed surge of QOZ investment activity in 2027. The bill provides a rolling 5-year deferral for investors based on their respective date of investment, starting for investments made after December 31st, 2026. Investors, regardless of the date of investment after that time, will be eligible to defer the recognition of their gain for 5 years. So on a rolling basis going forward after the end of next year, everyone who invests in a qualified opportunity zone fund will get to defer the capital gains tax on whatever was the original asset they sold for 5 years. If held for 5 years prior to the expiration of the deferral period, a 10% basis step up on the deferred capital gain would be eligible, increasing to 30% if such investment is made in a rural opportunity zone fund. And let me translate that. What that really means is, in addition to deferring the capital gains tax that you otherwise would have paid, you basically get a 10% refund, or a reduction, I should say, a 10% reduction on the capital gains tax that you would otherwise pay. And that reduction is enhanced to 30% if the fund that you are investing in is investing in properties located in rural opportunity zone funds as opposed to urban opportunity zone funds. So obviously some politics went into trying to drive a little bit more investment in rural states. The bill did change the definition of eligible census tracts by adjusting the definition of low-income community, and that low-income community threshold falls now from 80% to 70% of the area or statewide median family income. The bill states that if an investor holds their interest in an opportunity zone fund for at least 10 years, then the basis of their investment shall be equal to its fair market value as of the earlier of when the investment was sold, or a date that is 30 years after the date the investment was made. And so what they've done here is allowed an avenue for an investor to get the tax-free growth benefit of an opportunity zone fund investment for a maximum of 30 years. But I think most of these funds are designed so that after 10 years, there will be a liquidity event, and then when you cash out, at that point you will have already paid your capital gains tax on a discounted basis on whatever asset you originally sold way back when, and then you'll be able to liquidate your investment without any capital gains tax on the appreciation that hopefully you've experienced in the qualified opportunity zone fund itself. So again, this is an attractive second choice solution for 1031 exchanges, and where we've placed clients in the past in qualified opportunity zone funds is situations where either they sold an asset that doesn't qualify for a 1031 exchange, usually a stock or a business or a vacation property, or for whatever reason, the client had a failed exchange, or they missed a deadline, or they somehow didn't make the decision to do a 1031 exchange in time. And so investing in a qualified opportunity zone fund can be a great backup plan for traditional rental property, and a great first choice for any asset that you sold and that was highly appreciated that wouldn't otherwise qualify for a 1031 exchange. A lot to talk about on this topic. Hard to cover the entire topic of QOZ funds in a few minutes, but the biggest takeaway with respect to the One Big Beautiful Bill is that the qualified opportunity zone funds have been made permanent, and that the tax deferral benefit going forward is a rolling 5 years. And the whole industry was really excited to see this permanent change for what turned out to be a really attractive opportunity for everyone selling highly appreciated assets. Okay, next topic. Expense deductions, and try to stay awake here. This is, after all, a tax bill, and some of this stuff gets in the weeds, but it's important. And at the risk of oversimplifying, there are two general categories of expense deductions for rental and business property owners. Section 179 refers to expenditures on assets that you are allowed to treat as an immediately deductible expense. Common examples would be things like office furniture, small appliances, and technology. And existing law caps the amount that you can deduct under Section 179, and also ties that cap to your total amount of spending. Bonus depreciation is very similar. This concept allows assets that would otherwise be depreciated over a period of time to be front-loaded, either partially or fully, to the year of acquisition. And examples would be land improvements such as irrigation, fences, and sidewalks. And as you may recall, existing law had phased out the bonus depreciation of these types of assets to only 40% of the cost incurred in 2025. So the opportunity to bonus depreciate or accelerate the depreciation period for acquiring these types of improvements over the last few years declined and really became less advantageous at only 40% of the incurred cost today. I should also note that Section 179 deductions are limited in their application to to taxable business income, and cannot be used to create a loss while bonus depreciation can be used to create a net operating loss. However, bonus depreciation must be applied to all assets in a given class in the year, which makes it a little less precise than Section 179 if you only want to partially expense purchases. And my point here is that for a lot of situations, you may have an overlapping opportunity to choose Section 179 versus bonus depreciation, depending on what the asset is, and whether to use one or the other. If you have that choice, is a decision you have to make with your tax advisor. But these are related and slightly overlapping opportunities that have the one thing in common, which is being able to take a depreciation deduction in the year of the expense. Well, the new law makes the distinctions between Section 179 deductions and bonus depreciation a little less meaningful, because in either case, you are now deducting 100% of the expense in the year of acquisition, subject to a $2.5 million deduction limit for Section 179 assets and an increased expenditure limit of $4 million. Now, remember that these rules are simply compressing the time over which you are claiming a deduction, meaning that you are trading a deduction today for a deduction in the future. Furthermore, particularly in the case of accelerated depreciation, you will owe depreciation recapture tax back to the IRS at a higher rate than long-term capital gains if you sell the property without conducting a 1031 exchange. Speaking of 1031 exchanges, especially for larger transactions, the now permanent 100% bonus depreciation rule, and by the way, when we say permanent, as you all know, nothing's really permanent in a tax law because the next Congress can come around and change it. But we say permanent meaning as opposed to a law where there was a built-in sunset clause into the provision, okay? But the quote permanent 100% bonus depreciation rule may present an opportunity to get a significant deduction from your new replacement property in a 1031 exchange, in addition to deferring your capital gains taxes. And bringing this closer to home to what I do all day long, some 1031 DST properties even come with an off-the-shelf cost segregation study, which makes it easy for your accountant to determine what your share of depreciable assets would be. And so if you're thinking about selling a rental property, doing a 1031 exchange, it's possible that in addition to that, to the standard and considerable tax benefit of actually deferring your capital gains tax in the 1031 exchange, you can even pick up an additional tax benefit depending on the scenario by now being able to deduct 100% of the bonus depreciation qualified assets that were part of the property you acquired in your 1031 exchange. Okay, so with that, topic 3 is the SALT deduction. And this is in the news so much, I'm sure you're well aware of this, but SALT taxes refer to state and local taxes that individuals pay, including state and local income tax, property taxes, and sales taxes. And these taxes obviously can significantly reduce disposable income, especially in high tax states such as California, New York, and New Jersey, among others. In fact, Oregon, for that matter. So to ease this burden, the federal government traditionally, up until a few years ago, allowed taxpayers to deduct SALT payments from their federal taxable income. However, this deduction, as you probably remember, was significantly limited by the 2017 Tax Cuts and Jobs Act, which imposed a $10,000 cap on SALT deductions. And for some people, that was less than their property tax bill on $1 million property. So that was a major tax hit for folks who are used to being able to deduct all of their state and local taxes. Well, as you probably heard, uh, as of 2023, this $10,000 deduction cap remained in effect for single filers, heads of household, and married couples, while married individuals filing separately were limited to $5,000 each. That had carried through all the way through this last tax year, even though along the way there was hope that different Congresses might lift that limit. And that cap applied regardless of actual SALT liability, which means, of course, many taxpayers, particularly those in high tax jurisdictions, could not deduct the full amount that they pay in state and local taxes. Well, needless to say, the existence of a cap on SALT deductions has been controversial, and the details of how to reset the cap were a major cause for debate and negotiation, leading to the final passage of the One Big Beautiful Bill. But as a result of all of those negotiations, up until, from what I can gather, up to the last minute of the bill's passage, the SALT deduction cap will now rise from $10,000 to $40,000 beginning in 2025. Eligibility, however, will phase out above $500,000 in income, and the higher cap will expire after 2029. So this is great news, of course, and for a lot of people, especially if you make less than $500,000 in income, the increase from $10,000 to $40,000 is very meaningful. But this is set to expire in 2029, so don't get used to this temporary lifting of the SALT deduction cap. The final act also preserves the deductibility of state level pass-through entity or PTE taxes, offering, I guess, near-term relief for individual taxpayers and real estate investors. This change is especially impactful for property owners in high tax states like California, though many property owners will continue to incur state and local tax liabilities in excess of the higher cap, again, especially if you're in a high income bracket. So to recap the SALT deduction, for a few years at least, for folks that make under $500,000 a year, there's a quadrupling of the limit of the ability to deduct the state and local taxes that include things like property tax, income tax, sales tax. Good news, not necessarily the news people were hoping for, especially if you live in one of the high tax states like California in the Northeast. The fourth topic, I think, is really, and maybe equally important, is to touch on the things that were actually not impacted by the bill. And this is important because along the way, I read so many opinions, so many op-ed pieces, so many articles of folks speculating on ultimately what was going to come out of this bill. And I believe that there may be people out there who could be under the impression that there were changes that actually did not occur as a result of the bill based on something they might have read, as journalists were trying to read the tea leaves on what was happening in Washington, D.C. So I thought it would be useful to also touch base on some of the things that were not changed. And first of all, the bill maintained and did not touch in any way the benefits of investing in oil and gas drilling programs. And I bring this up because this is a relatively small but incredibly important part of the business that we do at 1031 Capital Solutions. And for a lot of you out there, I know that especially that generate a lot of taxable income every year. Some of you actually annually will invest in oil and gas drilling programs that allow you to deduct a significant percentage of your investment each year into these programs based on decades old tax advantages of investing in oil and gas drilling programs. And happy to report that those benefits are unaffected by the bill, although there was talk that was a possibility. The bill also maintained the 20% deduction for qualified business income, although that's subjected to an updated income range formula. So if you've enjoyed that 20% QBI deduction in the past, you might want to just double check with your CPA that as to whether or not you will continue to benefit from that deduction based on your income. The one big beautiful bill also preserved the estate and gift tax exemption, and in fact, the exemption will increase from $13.6 million to $15 million beginning in 2026. And this is good news because I think second only to capital gains tax in how egregious the tax is the death tax. And the fact that lifetime exemption is set to $15 million really reduces the amount of families that are hit by the estate tax at the federal level. Of course, many states have their own state level estate tax. And for most of those states, the limit is much, much lower. So you still have to give thought to planning for, if possible, how to mitigate the impact of state death taxes. But at least at the federal level, we've got a much better cushion than when I became an attorney in 1997, when as some of you remember, the lifetime estate tax exemption was $600,000. And virtually anybody with any assets with their family had an estate tax problem. So thankfully, those days are over, at least for the foreseeable future. The bill also maintained the current 15% and 20% long-term capital gains tax rates. For most of you looking at selling your highly appreciated rental property and trying to weigh taking the tax hit versus doing a 1031 exchange, there has been no reduction in the long-term capital gains tax rates. And when you add the 3.8% NIIT tax to the long-term capital gains tax rate, you've got, if you're in the highest tax bracket, you're looking at a 23.8% federal tax on your appreciation of your rental property. And then to the extent that you have to recapture your depreciation, which for some of you is a significant portion of your total gain is depreciation recapture, that federal rate remains at 28.8%. So throw in tax in Oregon or California, for example, and it is possible to reach a 40% combined state and federal tax on your capital gains when you sell a highly appreciated rental property. And because of that, it's really next to impossible for a rational person to justify taking the tax hit on the sale of a rental property when there are so many options to defer and ultimately avoid those capital gains taxes by doing a 1031 exchange and rolling into investment programs that you can continue to defer for the rest of your life and get the step up in basis and ultimately avoid the tax altogether. Speaking of which, I'll skip down to the bottom bullet point. The one big beautiful bill also preserved the step up in cost basis. And again, there was talk along the way that that this budget package could have addressed any or all of these bullet points. And so it was with a sigh of relief that we were happy to see that Congress did not monkey at all with the step up in cost basis. For those of you who, I think most of you are aware of this, but for those of you who aren't familiar with the term, what we're talking about is when you pass away owning real estate and your heirs inherit property that would otherwise be subject to a capital gains tax under laws that have been around for decades. That capital gains tax is effectively wiped away at the federal level because of the fact that the quote cost basis of your property is reset or stepped up to whatever its value is at the time of your death. And so if your heirs immediately or soon thereafter liquidate your highly appreciated real estate, they don't pay any capital gains tax because the cost basis of your property is wiped clean and is reset to the value of the property on the date of your death. And so when we talk about not merely deferring but avoiding taxes in a 1031 exchange, what we're talking about is combining one or more successive 1031 exchanges with the other tax strategy of the stepped up cost basis, so that ultimately no one ever pays those capital gains taxes, and your heirs inherit whatever was your last 1031 exchange property, free of the tax burden that they would otherwise have without that tax law being in place. The bill did maintain the federal income tax brackets, and so those brackets are the same as last year. The IRS does change the rates based on its annual formulas, but the brackets themselves are the same. The bill also maintained all 1031 exchange benefits and procedures, and there are, as some of you have heard me say before, there's a pretty vocal group of politicians in Washington year after year seeking to chip away at 1031 exchanges and the step up in basis, either one or both of those. In fact, again, I'm not trying to be political, but during the entire Biden administration, on the White House website, one of their stated goals on the White House website was to eliminate 1031 exchanges. So this was a very aggressive stance, and thankfully, that was really not something that was likely to happen based on the composition of Congress. But behind the scenes, year in, year out, there's always a group of folks who are happy to reduce or eliminate the benefits of a 1031 exchange, and particularly the step up of basis, which they describe as a loophole for the rich. And my dad joke is always, any tax benefit that you have to die to receive is not a loophole. But lastly, the One Big Beautiful Bill maintained the ability to do a transfer of real estate into a real estate investment trust under what's known as a Section 721 transfer. This is another area that the White House was picking on in the previous administration. Happy to see that was left untouched, and we continue to be able to offer folks an exit strategy where you do a 1031 exchange into what we call a pre-REIT investment property that is designed to then roll a couple of years later into a real estate investment trust. And when the dust settles, you've through a 1031 exchange followed by a 721 transfer ended up owning operating partnerships units in a real estate investment trust, and therefore are able to enjoy an investment in a multi-billion-dollar portfolio, typically with stable net asset value and income, and with the option to be able to redeem your shares in the future and provide a pretty estate-friendly asset for your kids when you pass away. Again, still enjoying the combination of the 1031 exchange and the step up in basis. So this has become an increasingly popular tax strategy as part of our 1031 repertoire. And so from a selfish perspective, we were happy to see that all of this tax strategies that we employ for our clients were either left untouched or enhanced as a result of the One Big Beautiful Bill. So from that narrow perspective, and frankly, from the perspective generally of all rental housing providers, I would have to grade this bill as being, again, without getting partisan or political, as being a net positive for hardworking Americans that provide rental housing. And so I think there's a little bit for everybody. And I think if you happen to live in a high tax state, and I know many of you on this call are in California, this was a net positive for all of you from a tax perspective. So with that, Alexandra, I'm at the conclusion of my prepared comments, and maybe we can take a few minutes to answer any questions.
Yes, absolutely. We did get a few questions. So if everyone can please put your questions in that Q&A box, not the chat, that'll make it a lot easier for me to keep track of the questions that we've already answered. I'm also going to launch a poll question here for you all. If you would like to schedule a complimentary consultation with Rick and his team, really to learn how you could exchange your rental property for a better lifestyle, or if you just have questions about today's presentation, if you say yes here, I'll be sure to forward your information to Rick so he can reach out to you after the webinar. Okay, so let's get into some Q&A here. Heidi had a few questions. First one here, if a child buys her parents' rental property and then the parents do 1031 exchange, is this scenario okay for 1031 exchange?
You have to be I think I understand your question. So you have to be very careful in what's called a related party exchange. That the IRS frowns on related party exchanges because of the opportunity for abuse, and for ultimately the family itself, they end up paying less taxes than they would if they were transacting with third parties. And I'm, by the way, this can get a little bit detailed, so I'm happy to discuss this with you offline. But the key in a related party transaction is that everything has to transact at market prices, and the folks doing the exchange have to own their replacement property for a specific amount of time. So there's a look back period where the original exchange could be disallowed. So there is IRS guidance on when related party 1031 exchanges will be allowed, and I would be happy to go through the details on that with you. But yeah, it's more than I can get into just on a quick answer on this call. But happy to walk through that with you, and I can send you some information as well.
Great. And she also asked, is it okay to sell property in one state and buy 1031 exchange property in a different state?
We're doing that 99% of the time with all of our clients. It's a great question. The vast majority of our clients are selling real estate, typically near where they live on the West Coast, for example, and then relocating their equity with us into properties that are in states where they are landlord friendly and business friendly, and there are prohibitions against rent control, and places where people are moving to, not moving from, and where there's low or no income tax. So the typical transaction would be a client of ours fed up with being a landlord in California for all the reasons that you're all too familiar with. And then we put them in a program where the underlying property that they're investing in is in the Southeast, in Tennessee or Texas or Florida or Georgia or Colorado, and in a much more taxpayer, business friendly, landlord friendly state. So yes, absolutely, that's a key part of what we're doing with our clients every day.
Yeah, it definitely is nice to diversify here. And Heidi asking, is Utah a good state for rental? And Tom asking, what do you think are the top five landlord friendly states?
Well, as an example, the Texas Constitution prohibits local governments from imposing rent control, right? Um, can you imagine that in California? So, I mean, it's a little bit of subjective, but in terms of, being in a place where if you owned a rental property where you're going to have a different experience in terms of how to obtain your clients, your tenants, how to screen them, and then how to interact with them, and then ultimately, if necessary, how to evict them. And by the way, these are everything I just described. Alexandra knows more than I do about that because this is the world that AOA lives in, and advising clients on the day-to-day work of all that. But at the higher level, regulatorily, the anywhere in this from Texas east in the southeast, or all those states are all going to be dramatically more landlord friendly than California. So it's more of it's a regional answer, I guess, is what I'm saying. And people had depending on where you were during COVID, you had a much different experience of being able to deal with problem tenants. Being in California versus South Carolina, for example. So anyhow, anywhere in the southeast is going to be the most landlord friendly.
Yeah, absolutely. And then you're weighing that against also rising property values, which, may change. So yes, a state like California, New York, your property value is probably always going to go up. But you are going to deal with a lot more regulation. So I also think that's a reason why people do like to invest in the DSTs, because if you don't know that market, the maybe out of state, DST is being managed professionally by a team that does. So that feels probably a little lower risk for most of you if you did want to expand to more states. But regardless, whatever state you do choose to expand to, you need to either be the expert in that market or work with someone who is to really get the most out of it. Even if it's the most landlord friendly state out there, you still got to know what you're doing. Okay, so let's go to here another question. Scott, he said, I'm confused by the beginning statement that capital gains tax is double taxation. If I make $1 in earned income or interest in the bank and I use that dollar for an investment, my basis at that point is whatever I pay, and then I pay taxes on a gain from that cost basis. So how is this double taxed?
Well, I'm referring specifically to situations where you could sell an asset like a stock, where that investment has already been subject to multiple layers of taxation, along the way, and then you sell that stock, and then you're hit again with capital gains tax on the sale of that stock, and more importantly, for a lot of assets, what we call appreciation is really just inflation. And the double taxation refers to the fact that you're getting hit one last time as you're walking out the door, metaphorically, with this asset upon its sale, on an asset that you've already, been taxed in various ways on. And then on top of that, being taxed in many cases, the tax is just simply an inflation tax. If you have a property of any type, but let's just say a rental property, and it improved 3% per year over a 15-year hold, well, that's then you haven't outperformed inflation with your capital appreciation. Obviously, if you own a California property, hopefully over that time it performed better than inflation. But for our folks in the Midwest and other places where property values don't accelerate at the same pace as they do sometimes on the coast, and then you're paying a capital gains tax on the appreciation that averaged 3%, then almost all of that quote appreciation was really just the property keeping up with inflation, and you actually in real dollars, you didn't actually realize any gain on the sale of that property, because that property in terms of the original dollars of when you bought that property didn't go up at all. It's because of the accounting for inflation. And I think that's the most egregious aspect of the capital gains tax, is the fact that you're being really taxed on fake appreciation.
Yeah,
It's just it's an inflation tax.
exactly. Yeah, Miriam in the chat says you don't get to deduct inflation. So that would be
Yeah.
nice if you did. I think that would be a lot more fair. So we'll see if that ever happens. You never know. Tom says here, what happens to a property that has reached its last year of depreciation? Are there any benefits here that apply to a scenario like mine?
Well, you raise a good point, because when it comes to things like accelerated depreciation, et cetera, if you do a 1031 exchange into a property, into a very similar property with the same ratio of improvements to land value, and you've already completely depleted your depreciation deduction over time, then uh, there's no there won't be any additional benefit in your 1031 exchange into the new property, because you've already exhausted all of the depreciation. And when you do a 1031 exchange, you don't get to start over uh, on your depreciation, unless, and this is a huge unless you invest in a property in a 1031 exchange where the property that you're buying has a higher value than the property you sold. And this actually happens a lot in our space, because we do have clients that had low or no debt on the property they sold. And then they'll invest for example, in a DST program that says that perhaps has a 40% loan to value baked into the investment program. And so even though you put in $1 million, you acquired $1.25 million worth of real estate for tax purposes. Well, that additional $250,000 of real estate that you acquired because of the fact that there's built-in financing on that property, that's new real estate to you. And you can start a whole new depreciation deduction schedule of that incremental increase in real estate. Furthermore, most of the programs we're putting clients in are located in states where the improvements are a much higher percentage of the value of the property than, say, Southern California, where the land is 60% of the value. And if you buy a DST property and it's a FedEx distribution center outside of Atlanta, Georgia, and it's 90% of the value or improvements, then in my example, then you could depreciate $225,000 of depreciation new starting at that moment, and even have some bonus depreciation available in that scenario. And then suddenly you now have a new depreciation deduction that you didn't have on the property you sold. So there are opportunities to achieve new and greater depreciation deductions in a 1031 exchange, based on the opportunity to acquire more real estate than you sold, at least on paper.
Mm. Thanks for that explanation. Heidi had a follow-up on that. She says, in the case that depreciation has been exhausted and you're doing a like-kind 1031 exchange, the disadvantage is now having to pay higher property tax, correct?
Well, whether you're going to pay higher property tax on your replacement property is a function of where was your property and what is your property tax basis. You are correct. In thanks to Prop 13 in California, if you've owned a property for 20 years, you are likely, for property tax purposes, at an assessed value that is significantly lower than what the assessed value is going to be of your replacement property. There are other states that have lower property tax rates than California. Despite Prop 13, it's that last I checked, California is ranked 16th in despite Prop 13 in terms of the actual taxes that people pay because of partially because of all the other taxes that local governments pass on top of the ad valorem tax. So whether or not you are going to have a higher property tax bill on a replacement property in 1031 exchange is has some variables, including how long did you own your other property, where was it located, and where are you buying your new property. But to your point, you are correct. That is something you have to factor in when you're doing any kind of real estate analysis on a replacement property in 1031 exchange is your revenues and expenses, and how is that all going to add up to a new net operating income. I will take the opportunity to tell you though that for the vast majority of our clients, we are increasing their income when we do a 1031 exchange simply by virtue of the fact that our clients are selling highly appreciated real estate in places where the property value over the last 15, 20 years far outpaced the growth in rental revenue. And when that happens over time, your equity in your property grows faster than your rental income, and your net income as a percentage of your equity that may have started off at 6% or 7% when you bought the property is now down to 2 or 3%. And if you're getting a 2% yield on your equity, and you reinvest in a program in the Southeast paying a 4%, 4% doesn't sound very exciting, but 4% still doubles the income that you're getting on your California rental property. That is what I just described is not exaggeration. This is a typical scenario. So again, when your property appreciates much faster than your rental income, over time you start to develop what we call debt equity. And debt equity is a killer because now you're not realizing the income that you should be receiving commensurate with the risk and liability and hassle of being a rental property owner.
Great explanation. So we have a couple questions on the qualified opportunity zone. So switching gears to that, I am dropping a link here in the chat for everyone right now. If you want to go to the chat for a map that shows you where they are. So someone was asking here, are these zones determined by city, county, state, or federal? Do you have to contact a ruling authority, or can you search in one location? So this link here will give you the ability to search for that. But any comments there on how these zones are determined, Rick?
Alexander, I'll tell you that the zones are determined largely by the governors of each of the respective states who were originally given criteria created by the original law for how to determine where the zones would be. And when you combine the federal government and state governments together to come up with where zones should be that have tax benefits, it should be intuitive to you that is a recipe for politicking, obviously. And so the 8,700 zones that all sort of came out of the 2017 bill are now going to be basically replaced with a new set of zones that will all be released in July of I believe it's July of 2026. So and unless you're going to invest soon in a qualified opportunity zone fund, it's quickly becoming less relevant where those zones are located. Now, I would have to assume that based on the criteria, many of the zones today will survive that review. But from what I'm told by folks in the know, that there will be fewer zones than the 8,700 that exist today, partially because they clamp down on the on what are the eligibility requirements from an income perspective. Uh, but for those of you who own property in a qualified opportunity zone fund zone, in a qualified opportunity zone, then even if you're not interested in investing in a QOZ fund, you still want to know if your real estate is in such a zone, because that can enhance its market price, particularly those of you who might own property that is that own, where you have vacant land, or you've got property that could be worth more to a developer than it is to a future investor for the rental property you have. So it's a good idea to be aware of whether your existing real estate is in a QOZ simply for future sales purposes. But yeah, we won't know where the new zones will be located until next year.
Okay. All right. We'll look out for that. And Rick, if you could go back to that opportunity zone slide. So we have a couple people asking what rules have changed. And I know you covered that earlier, but it'd be nice to have that pulled up. And then someone else, Aaron, asked as well, just to clarify, if the QOZ qualified gain, it used to be from 6 months before the investment, is it still the same? Maybe you might know that.
To my knowledge, I have not heard or read that there was any change in the rule about needing to invest within the 180 days after the trigger event. And so it's a great question. To the best of my knowledge right now, that aspect of the procedure of being able to defer the gains by investing, reinvesting those gains into a QOZ fund within the 180 days after the date that you sold whatever the asset is. To my knowledge, that has not changed, and will continue to be the procedure going forward when the new zones are rolled out. So yeah, I've not heard that they tinkered in any way with that particular timing element.
Yeah, I didn't see that either. Shauna here was asking, if you have a property in the qualified opportunity zone right now, but then in 2026 it changes, does the tax benefit grandfather in the future? Or if I don't sell before the rule change, do I lose the tax benefits?
Well, it's a very good question. If you are invested in a QOZ fund today, none of this affects you better for better or for worse. In other words, all of the factors that applied to your investment are in place, and you will have to you'll have to pay your deferred capital gains tax before you file your 2027 taxes. So that's what we typically say. The spring of 2027 is when the deadline is, because that's when people are paying their taxes for the 2026 tax year. And so and the benefits that apply to the 10-year the whole period of 10 years, and being able to essentially avoid the subsequent taxation of your gains in the fund after holding that investment for 10 years, that still applies. So all the terms and benefits of your investment at the time of your investment are all preserved for you at the individual level and unaffected by the bill. And these updates that you see on the screen are really now applicable to anyone who invests in a QOZ fund going forward after December 31st, 2026.
Yeah, and Mia was asking, does a new area roll out every year?
So what they're going to do is they're going to designate the QOZ zones every 10 years.
Mm-hmm. Okay, starting soon. So there are a couple more questions here on basically selling property and passing it on to your heirs. So One of the questions, I know an older gentleman that has a very low basis and is reluctant to sell because he's waiting to pass it on and let the kids have the step up basis. Is putting it in a trust an option and then selling it from the trust?
Well, I'm gonna take a leap here and assume that maybe what you're referring to is a strategy that's out there floating around. One group has it trademarked as deferred sales trust, um, and and the idea behind this strategy is someone who has highly appreciated real estate who doesn't want to continue owning real estate transfers that property to a trust in exchange for a 10-year promissory note, for example. That's the typical. And so and then the trust now owns that real estate. The real estate then sells the property to a third party and then uses the proceeds of that sale to then make the annual installment notes that are owed back to the original taxpayer. And when the dust settles on that type of scenario, what you end up with as the investor is the income stream from a 10-year promissory note, and you will, assuming no fraud, you will receive those each of those payments, and you'll pay the taxes over that time. So you're merely deferring all of the capital gains tax, over a 10-year period, and as opposed to a 1031 exchange where you actually avoid the taxes altogether when you pass away. What happens in that scenario is then if you pass away before that installment note has paid out, then your heirs will inherit that promissory note. But unlike real estate, where you get the step up in basis and the capital gains tax goes away, the capital gains tax does not go away on the note. And so whoever inherits that promissory note from you continues to make the capital gains tax payments that are owed with every payment from that note. So you haven't achieved any tax avoidance. You've just passed on the capital gains tax to your heirs. And secondly, to the extent that pool of money that is now generating the income stream, to the extent that it appreciates beyond the original sale price of the property, that additional appreciation does not get passed on to your heirs, and you don't get that back, and that just gets held by whoever you hired to put the trust together. So you lose the opportunity to receive or to bequeath that additional appreciation that, of course, you would completely continue to have if you 1031 exchange into a passive investment. So this strategy is a great strategy for financial investors who are looking for opportunities to convert their clients' rental properties into a pool of funds that they can manage and collect fees on. But from the taxpayer's perspective, it's really hard to rationalize why you would go the route of a deferred sales trust type of strategy instead of just doing a 1031 exchange into passive real estate, where you can continue to get depreciation benefit and where you get the full step up in basis when you pass away, so that the kids, neither you nor your heirs, ever end up paying those capital gains taxes. And almost every time I sit down with somebody who's trying to figure all this out, once they just get an objective comparison of a 1031 passive replacement strategy versus a deferred trust strategy, it's not even close as far as what is more beneficial from a tax perspective. And if you're somebody who really just wants to avoid owning real estate altogether, you have to remember that when you invest in a passive real estate program, you are no longer involved in the operation of that real estate. So while your underlying asset, of course, is real estate, you are now no longer owning and operating that property directly. And if your goal is simply to just unburden yourself from the hassles of being a landlord, we can achieve that without you giving away your property to an irrevocable trust and then losing all the tax benefits of continuing to own that property. So anyhow, if I, you are welcome to schedule a call with me, I'm happy to talk about the pros and cons of these strategies in the context that you described in your question. Excuse me.
Yes, and I will add, Rick has a really awesome calculator that you all could use, and it's on his site. But I really think that is helpful because I'm looking in the chat, and Miriam says that's why it's called swap till you drop. But Heidi says, well, in that swapping, property taxes increase. Then you also have to look at, well, how much are you saving in those capital gains taxes, and if that doesn't add up to being worthwhile, that's another conversation to have. But you certainly should try to see if it's worth it, because just to avoid certain costs now, or even with a deferred sales trust, you may be forfeiting other benefits that could be greater than what you're avoiding. And so we want to make sure with any decision, and it's different for everyone depending on what your portfolio looks like, if it actually does make sense. And so that's something that Rick's team can help you with, and Rick as well, to make sure you have all the numbers and can make that decision. But ultimately, like Rick was saying, if you really don't want to be involved in that management of real estate anymore, then that also might be a factor as well. How do you put a value on that? It's not really a dollar amount, it's really peace of mind. And so if that's something you also are looking into, just not having as a headache anymore, Rick would be able to help you with that. So a couple of questions here. Matt says, can you comment on the Delaware statutory trust, different type of DST, as options with a 1031 exchange, particularly for completing an exchange with no more depreciation?
Yeah, I alluded to that a little bit, but that, and I don't want to turn this into a DST commercial, but the most of the transactions that we are helping clients with in a 1031 exchange are investing into Delaware statutory trust properties, typically a multifamily Class A property that's a $100 million property in a suburb of a major market, and so you go from selling, typically a rental housing property that you are owning and operating. Perhaps you have a property manager, but essentially maybe a 1 to 4 unit property close to where you live, doing a 1031 exchange, and on the other side of that, investing as a fractional owner in a Delaware statutory trust that owns this $100 million Class A new apartment community, and you are essentially receiving your pro rata share of all the net income of that property. You get to receive your share of the depreciation, subject to your own depreciable cost basis, of course. And then ultimately, you get your pro rata share of the appreciation of that property. And by the way, if I'm increasing your income by 50% or doubling your income in that 1031 exchange, it may be less relevant that the underlying property tax for your share of that investment may be higher than what you sold. At the end of the day, if the net of the revenues and expenses is a significant increase to your income, I'm not sure how important it is that one expense item may have gone up in the context of a significant increase in your income. But as I mentioned earlier, in that scenario where you've depreciated your rental property and you invest in a DST that has built-in financing, then we routinely are helping clients increase their depreciation deduction by investing in DST's properties that not only have built-in leverage and therefore allow you to acquire more real estate, but are also, as I mentioned, located in places where there's much more depreciable improvements than a typical West Coast property. And so you sort of get the double benefit to sort of start over a new depreciation schedule, even when you've fully depleted the depreciation on the property you sold.
Right. Well, that sounds like good news for, I think, some of you on the call. So I'm going to probably just stop it here. There's a few more questions, but I think probably best answered offline. Matt just commented, I would assume a DST has less headaches at tax time as well. I would say that's probably true. Another reason to want a DST.
You get a Schedule E form.
Yeah.
That's the same form that you use now on your property, except instead of you spending weeks pulling together all the numbers to go in your Schedule E, the DST sends you, a 1 or 2 page document at the end of the year, and your accountant drops those numbers into your Schedule E, and you're done. So yeah, a much easier
Much
accounting
easier.
tax process.
Oh, that's good. Okay, so just to wrap up here, we are sending everyone the recording tomorrow. If when you registered, you said that you wanted one of Rick's resources, including that How to Retire from Real Estate book, then I'm going to share that list with Rick. His team is going to get back to you with either the digital or hard copy of the book. If you didn't have the opportunity or said no, you changed your mind, don't worry. I'm going to include it in the email tomorrow as well with a link so you can still get that copy of the book. It will also have Rick's contact information. If you said on the poll that you did want a consultation, his team will reach out. But you can also, through the email I'm sending tomorrow, schedule a consult if you didn't have a chance to answer that poll. And then, of course, we're going to provide you with the recording and the slides. Feel free to share them if you want with anyone you know that might be interested in this topic. And thank you, Rick, for so many new updates and details on everything going on. I think this was super helpful. I got some thank yous in the chat already. And, for those of you who haven't commented yet, when you are leaving, please check the exit survey. I'd love to hear what you thought about today's presentation. And Rick, yeah, thank you again for staying a little longer and answering everyone's questions.
You're quite welcome. Thank you, everybody. Appreciate your time. Don't be shy about reaching out to us, and Alexandra will see you on the next webinar.
All right, everyone. Bye.
Bye-bye.